All right, chapter 1. So this is a typical introductory chapter. Get into some terminology and ideas around the federal tax system. Understand that this, for the most part, is what we're talking about is federal income taxes. And in this case, this term, we're dealing with primarily taxation of individuals, although the taxation of individuals could include individuals who are in business for themselves, also known as a sole proprietorship. So we get into some taxation of business entities, which is the advanced tax course, somewhat, but more focused towards individual income tax and people who are not so much self-employed, but again, there is some of that. So anyway, I urge you to look at the learning objectives. I don't normally sit here and read them to you though. So first thing we talk about is who cares about taxes and why. It's pretty prevalent in your lifetime. If you've ever received a paycheck, I can still remember when my 13 or 14-year-old son started working as a busboy or something like that at a restaurant. He, first couple of weeks before getting paid, he was like, tallying up in his mind how much he was going to make based upon the number of hours he worked times his hourly wage, and he was just, of course, he probably had it planned what he was going to spend it on too, and so after his first couple of weeks, he gets his first paycheck, comes home with this glum look on his face, and I said, what's wrong? And he's like, well, what's all this stuff they took out of my paycheck? It's not as much as what I thought it was going to be. So I had to explain to him that the concept of gross income versus net income, it was quite funny in a way, but he didn't think it was funny at the time. As far as businesses are concerned, the idea of taxes comes up in the type of business formation you use, because different business forms have different tax structures. Where a business is located could determine the amount of taxes they pay. How you structure a business transaction could determine the amount of taxes that you pay. It comes up when determining what to pay employees. It comes up when determining whether or not or how you mix debt and equity together in the business. Renting or owning equipment and other property may have tax implications. And distributing profits to the owners of the business definitely has tax implications as well. Politicians care about taxes because they have they're walking this fine line between satisfying constituents and making sure that the government has enough money to run on. Of course, it can also mean how much power that the politician has as well. Of course, voters generally, not always, but if you're a contributing member of society and pay lots of taxes, you're concerned about what your politician is doing, whether or not they're wanting to raise taxes or lower taxes. If you're not a let's say you're a user of government services, you're worried about whether or not taxes are going to be cut, and thus your services are going to be cut. So there's always this conflict going on. Owning a home is a simple, basic decision that individuals make, whether or not I own versus rent. Whether you own or rent has tax implications. One thing you'll learn is that the tax code is very heavily weighed in favor of home ownership because of all these things that the government allows you to do when you own versus rent. So you may actually benefit tax-wise from owning a home versus renting. Retiring has tax implications. And so there's tax advantage methods saving for retirement through your employer or otherwise. So what qualifies as a tax? Not everything the government does when they collect money is considered a tax. And so the book defines a tax as a payment required by a government that is unrelated to any specific benefit or service received from the government. If there's a specific benefit or service received in exchange for payment, that's considered some sort of fee, service fee, not a tax. And so taxes are different from fees. They're different from penalties as well. So the key components of a tax are that a payment's required, the payment's imposed by some governmental agency. We focus mainly on federal agency here, the IRS, and payments not directly tied to a benefit received by the taxpayer. So you got those three components. So here we have a question: which of the following constitutes a tax? Payment for driver's license. Well, no, that's not a tax. That's a fee. You're getting the benefit of being able to drive. Payment for required by government house appraisal. Well, that's not a tax either. Payment for hotel use of 1% of bill to pay for city projects. That's a tax. You got to pay it. If you're going to stay at a hotel, you got to pay this 1% tax. Payment for rental car use of 3% of bill to pay for the roads. That's a tax as well. All right, so how do we calculate tax? Well, the amount of tax is calculated by taking the tax base and multiplying it by the tax rate. Now, the tax base is what's actually taxed and usually expressed in monetary terms. And so you have $30,000 of taxable income. That's your tax base. And so you're going to take that tax base and multiply it by some percentage. That's the level of taxes imposed on the tax base and usually expressed as a percentage. So let's say that, and again, you would think that to calculate the amount of taxes, you would simply take the total amount that an individual earns, let's say the $30,000, and multiply that by 1%. Well, that's not how it works in the federal system. We have a graduated tax structure, so you can't just take $30,000 and multiply it by 1% number because it graduates the tax rate. The more you earn, the more you pay in those later dollars. So there's different ways to measure tax rates. One of them is called the marginal tax rate, and so they go into pretty deep detail here. But for your purposes, I want you to realize what a marginal tax rate is. It's the tax rate that applies to the last dollar or any additional increment added to a taxpayer's income, okay? And so let's say if you look at the back of the book, okay, at the 2015 federal rate schedule, and if you look under single, Schedule X, note the graduated tax structure. If you make between $0 and $9,225, you're taxed at 10% of taxable income. So let's say you make $80,000. $80,000 is your taxable income. What is your marginal tax rate? Well, it's 25%, because on that $80,000, you pay 25% on that last dollar you earn. So your marginal tax rate is 25%. Now, what if there is some proposal that's going to increase my income by $15,000? So then I'm going to make $95,000. Well, what's my marginal tax rate? It's somewhere between 25 and 28%. It's not 25 because your income's increased, and part of it, anything above $90,750 is taxed at 28%. So it's a mix of both 25 and 28% that you have there in that total increase of $15,000. So that's kind of how that works. Don't get too concerned if you read the examples and you don't quite understand it. Average tax rate. So here you take the total tax and divide it into taxable income. And so this is the taxpayer's average level of taxation on each dollar of taxable income. Because we are taxed at graduated rates, you're not taxed a flat amount on all taxable income. You're taxed at various levels, okay, as we saw in our tax tables at the back of the book. And so your average rate includes all those different levels. And so let's say you pay $5,000 of taxes on, I don't know, $40,000. So what is your average tax rate going to be? Well, it's going to be $5,000 divided into 40, or 13%. Then last is the effective tax rate. This is the taxpayer's average rate of taxation on each dollar of total income, both taxable and non-taxable. Understand, some items of income are not taxable, and so you don't include those in the marginal tax rate or the average tax rate, but you do when you're trying to figure out the effective tax rate. You have to consider all income, both taxable and non-taxable. So what's an example of a non-taxable item of income? Interest on municipal bonds are non-taxable, but they're income to the taxpayer or the person who holds the bond. So we have this example. You got $160,000 of total income, additional $10,000 of non-taxable income, and so they're filing filing joint tax rates. So they ask the question, what's their tax due, their average tax rate, and effective tax rate. Additional question is, if they receive an additional $80,000 of taxable income, what is their marginal tax rate on this income? So tax due is $31,851.50. You simply have to look at the back, the tax rates at the back of the book. Of course, you know, if you're using software, tax software, this calculates it for you. Unfortunately for you, you're going to have to use the tax tables. It helps you conceptualize better if you use tax tables and figure out the tax due rather than using software that does it for you. So what they did, they simply went to Schedule Y1, married filing jointly, right in the middle of the page where it's if taxable income is over $151,200 but not over $230,450, they would look there. And the amount they owe is $29,387 plus 28% of the excess over $151,200, and so that's what, $8,800 is taxed at 28%. So that's how they come up with the $31,851.50. Average tax rate is 19.91%. They simply take the amount of taxes owed, divide that into taxable income. And then effective tax rate, remember they have $10,000 of non-taxable income, so they take that and add it to the taxable income to come up with $170,000. You divide that $31,851.50 into the $171,000 to come up with an effective tax rate of 18.74%. And then marginal tax rate, they simply ask the question, what would happen if they get, what would be their marginal tax rate if they added an additional $80,000 of income. And so they determine what the taxes owed would be for the additional 80,000. That's 54,279. You subtract that from the 31,851.50, and then you divide that number into the difference between the amount of taxable income they would receive if they did get 80,000 more taxable income minus their actual taxable income. So that would be your denominator. All right, let's talk about tax structures. I don't want to spend a lot of time on this because it's really not that big of a deal, but in theory, I think you need to know some of this stuff. There's proposals out there for a flat tax. Usually the number that it gets bounced around is 15%. And man, that would make things a lot easier. Of course, if you're a tax professional, it probably means you're out of a job. But flat tax would simply be the tax rate times taxable income. And it's a constant tax rate throughout the tax base. Very simple to figure out, probably save billions of dollars in collection costs and fees charged by professionals and all that junk. What we do have in the federal tax system is a progressive tax rate. The more you make, the more the tax rate is on the higher dollars. So you have an increasing marginal tax rate as the tax base increases. Some taxes, not the federal income tax, but some taxes are regressive, and because they impose a decreasing marginal tax rate as the tax base increases. And so some examples of regressive taxes are employment taxes. FICA is capped at like $112,500 or some amount like that. Anything above that, you don't pay employment taxes on. So from that standpoint, it's a regressive tax because the more you make past $112,500 or whatever the number is this year, you don't pay any taxes or employment taxes on that. You pay income taxes, but not employment taxes. Some consider sales taxes to be regressive because for people who make less money, it's a flat rate, but for people who make less money, that sales tax takes a bigger bite out of their available resources than a similarly situated person who makes more money. And so this just maps out how the structures look on a chart. All right, types of taxes. You've got federal taxes. Under federal taxes, you've got income taxes, which is the primary concern of this course, but we'll also talk some about employment and unemployment taxes. Not so much excise and transfer taxes. State and local taxes, you have sales and use taxes, property taxes. Some states have an income tax. Certainly, we have one here in Oregon. I believe Washington doesn't have one. I don't think Idaho does either. And then excise taxes. Just some numbers to throw out. Percentage-wise, income taxes represent 55.3% of all tax revenues collected, and most of that comes from individuals, not corporations. Although we have one of the highest corporate rates, tax rates in the world. Corporations find ways to not pay taxes. You might have heard of something called a corporate inversion, where an American company merges with, let's say, a company from Ireland where they have fairly low corporate tax rates. And so if they do it right, they can end up paying a lot less taxes. So that's why that percentage is so low, or one of the reasons why. Employment taxes are a big number. Again, I don't know why they cap the Social Security employment taxes, but they do. And I think they could probably the government could pay their bills better if they didn't cap them. There are also unemployment taxes taken out of the employer's portion. In other words, employees do not pay the unemployment taxes. Employers do, but it's a shared obligation for employment taxes. Implicit taxes, these are indirect taxes that result from a tax advantage the government grants to certain transactions. I probably won't ask anything on this, but you might just look over this. And they give some examples of, comparing a corporate bond with a municipal bond. Usually municipal bonds, because of their tax advantage to the holder of the bond, they're not taxed. The income on a municipal bond is not taxed. And so for that reason, usually the issuer of the municipal bond, the municipality, can charge or pay a much lower interest rate on the bond. And so the difference between that and what corporations have to pay on their bonds is considered an implicit tax. And so the implicit tax is defined as the reduced before tax return that a tax-favored asset produces because of its tax-advantaged status. It's difficult to quantify, but important to understand in evaluating the relative tax burdens of tax-advantaged investments. All right, evaluating alternative tax systems. This is only for eggheads who get into tax theory and what type of tax structure we should have here. Again, good to know. Great cocktail party conversation. Not really. But, just good theory to know, but not really much use in if you're a tax practitioner. One of the standards to evaluate different tax systems by is how sufficient they are. And sufficient involves assessing the aggregate size of tax revenues that must be generated and making sure that the tax system provides these revenues. Equity. How is the tax burden distributed across taxpayers? Should it be equal? Should those who make more pay more? Equity really is in the eyes of the beholder. I mean, if you're the one paying the tax, paying more tax burden does not feel equitable to you. If you're a taker of services, government services, so you're really not paying much or anything. Your idea of a high wage earner paying more taxes is different than the high wage earner's idea of equity. Let's put it that way. Certainty means that taxpayers should be able to determine when to pay the tax, where to pay the tax, and how to determine the tax. Certainly our federal structure is pretty certain as to when to pay the tax and where to pay the tax, not so much as to how to determine the tax. Depending on your situation, it can be very difficult to determine how much tax you owe. And this is why we have tax professionals. And just kind of a break in the action here. How do I structure this course? I structure this course, you can take this course to learn about how our federal tax system works, certainly from that standpoint. But I teach this course as if I'm training you to become a tax practitioner, okay? So some of this theory stuff is a little ethereal for me. Because in the day-to-day world of tax practicing, really doesn't matter. It is what it is. Convenience. Certainly, convenience is determined by how it should be designed to collect without much hardship to the taxpayer, and certainly that's not true of our system. It's not very convenient. Although it's a pay-as-you-go system, so if you're employed by someone else, your employer takes it out of your paycheck for the most part. So from that standpoint, it is convenient. Economy determined by whether or not it minimizes the compliance and administration costs associated with the tax system. Certainly that's not true, depending on what your situation is, but certainly high-income individuals usually have to pay a lot in administration costs associated with tax compliance, as it's called. Sufficiency. Here they talk about revenue forecasting. You don't need to know this really, but in determining whether or not a typical or a proposed tax system is sufficient, you have to figure out how much revenue you're going to earn from the tax system. So there's two types of revenue forecasting. There's static and there's dynamic. Static, it ignores how taxpayers might alter their activities in response to a tax law change. Dynamic, you take into consideration things like the income effect of new laws and the substitution effect. The income effect says that as tax rates go up, people will work harder to maintain the same after-tax income. Substitution effect says as tax rates go up, people will substitute non-taxable activities because the marginal value of taxable ones has decreased. Two types of equity involved: horizontal equity. Here you're comparing two taxpayers in similar situations, and equity says that two taxpayers in similar situations should pay the same exact amount. However, in our current system, that's not always true, because let's say you've got two taxpayers who make $40,000 of taxable income. One taxpayer rents and the other owns a home. Are they going to pay the same amount of tax? No. The one who rents is going to pay more in taxes because the person who owns the home is going to get certain deductions from their taxes in the amount of mortgage interest they pay, property taxes, and things like that. Vertical equity simply says that taxpayers with greater ability to pay tax should pay more relative to taxpayers with less ability to pay taxes. Certainly our graduated tax system does that. Certainly if you had a flat tax system, that wouldn't be the case. If there was just a 15% flat tax, those who earn more are going to pay the same amount percentage-wise as those who make less. The end.